The euro has been on a steady decline against the US dollar for quite some time, more than a year now, as the US dollar has remained strong during the fears of an economic slowdown. Naturally, the US dollar is a safe haven currency in much the same way that US Treasuries are a safe haven instrument, drawing people towards US debt, US companies at a time when the stock market is actually still around about those record high levels. That naturally brings focus back to the US dollar, drives demand for the world's reserve currency. And this has contributed to the gradual decline that we have seen throughout this period in the euro-dollar pair. As we approached 110, people started to once again talk about the prospects for parity. Now, while that's not necessarily off the table, if we are going to see that, I think we will have to wait quite a long time. And the gradual nature of the decline that we have seen in this pair would support that view. But in the near term, we are still seeing further downside. We've come back towards those 109s, as you can see on the chart right now. 109, 108.50 is an important level of support here. Historically, when we're talking years back when we were trading around these levels, that was a technically significant level for this chart. There is, of course, potential for this to continue to drop lower, but the fact that the Federal Reserve is expected to continue to cut interest rates will alleviate some of those downward pressures. Of course, we know that the European Central Bank has already announced a massive stimulus program, including a large QE program, which is now restarted, as well as an interest rate cut further into negative territory, and other measures to try and alleviate some of the pressures on the banking system and more TLTROs. But now that that is fully priced in, that could actually take some of the downward pressure off the euro, because I don't think anyone at this point is expecting an increase in that quantitative easing program or further stimulus measures, at least for the rest of this year, probably going into the first quarter of next year. However, the data that we have seen from the euro area has continued to be weak. We've seen manufacturing surveys from a variety of countries within the euro area, most notably Germany, which is now posting the weakest surveys since the global financial crisis for a number of different reasons, and it's now at risk of falling into recession. I think many people now see there's a great risk of the euro area falling into recession over the next 12 months. There is talk of recession, of course, in the US as well, but I still think we're away from that at this moment in time because it's continuing to post strong growth figures. But the ISM manufacturing PMI on Tuesday was a reminder that it's not necessarily immune. We saw a lot of risk aversion in the markets on the back of that PMI reading, which actually slipped unexpectedly into contraction territory. While that did create risk-off sentiment in the markets, it also did weigh on the US dollar a little bit because of the fact that this is a US-centric piece of data, and something which spells weakness for the US economy naturally spells a little bit of weakness in the near term for its currency. However, if these fears do persist, and if the global recession talk does continue to be ramped up, then we could actually see that relationship shift a little bit, because once again, we may see demand for safe havens such as US Treasuries, which are still yielding more than what we're seeing from other major developed countries, and that will naturally draw demand for the US dollar, which again is trading back at the kind of high levels that we haven't seen now for 2.5 years. That could continue to push downside pressure on the euro-dollar pair, even if we have seen that alleviated a little bit on the back of this an immediate knee-jerk reaction to this US economic data. In terms of where we go from here, if we see a break below those 108.50, 109 levels, then 105s do start to become more of an attention for traders. But again, I do still think this is going to be a slow, gradual move lower because of how much is priced in already on the euro side, and the fact that we are seeing now weakness in the US economic data.